The unicorn model. The unicorn model is a trading setup that combines a breaker block with an overlapping fair value gap. Before we dive into the details of this model, let me briefly explain these two concepts. A breaker block is a failed order block that transforms into a new supply or demand zone on the chart. From basic price action, we know that when the price breaks through a support level, it often becomes resistance because of how market participants react to that level. The same principle applies to order blocks. The market might ignore an order block for several reasons, such as a shift in market structure, the asset being overvalued or oversold, tapping into a higher time frame key level, and more. When a valid demand order block fails to reject the price and the price breaks through, it turns into a supply level. This is called a breaker block, and we expect the price to be rejected from this area. On the other hand, fair value gaps are also considered supply or demand zones. When a bearish FVG appears on the chart, it shows a sell-side imbalance where selling pressure has greatly outweighed buying pressure, often due to institutional activity. This creates a phase of market inefficiency, which usually causes the price to return to the FVG area to fill the gap and restore balance. This provides a trading opportunity to go short with bearish momentum, but only if there are still unfilled orders in the zone. That's when we see price rejection from these areas, followed by continuation movements. Keep in mind that fair value gaps must be unmitigated. FVGs are a one-time use. We only mark FVG areas that haven't been tested yet. If the price taps into an FVG zone for the first time, that's when we consider it a trading opportunity. After that, it becomes mitigated and is no longer valid for future trades. If you'd like to dive deeper into these concepts, check out our previous videos. Now let's return to the unicorn model. As we mentioned earlier, in this model, we look for a breaker block that overlaps with a fair value gap, creating a high-quality trading zone. When the price returns to this zone, there's a higher chance it will act as a strong supply area and push the price lower. In this case, we'll enter at the beginning of the zone, place our stop loss above it, and target the next key area ahead of the price. The same applies to bullish scenarios. For our first example, we'll look at the euro-dollar pair on the 5-minute chart. Focusing on the top of the recent impulsive movement, we have a fair value gap area. The candle responsible for this gap is considered an order block, marking a demand zone that could push the price higher. If the price retraces to this order block zone, we typically expect a rejection to the upside, signaling a bullish continuation. But what happens when the price breaks this zone without showing support? It turns the zone into a breaker block, flipping its role. The bearish move that broke below this demand area also created a fair value gap, signaling strong bearish momentum. Individually, the bearish FVG and the breaker block are valuable trading zones. However, when they overlap, they form a high confluence trading zone, making it a critical area to watch due to its increased significance. High confluence areas are zones where multiple price action signals align, making them more reliable. These areas attract significant attention from traders, as the convergence of signals often increases the likelihood of a strong market reaction. With so many participants monitoring these levels, they become key zones where traders anticipate and execute their strategies. Now, for the entry, you can set your sell limit order at the start of this high confluence zone. Place your stop loss above the zone to protect against market fluctuations. For profit targets, aim for a solid risk-to-reward ratio, such as 1:2 or 1:3, depending on key market structure levels ahead of the price. To manage your trade more effectively, consider making it break even by closing half of your position once the price reaches a 1-to-1 target. This way, even if the price reverses and hits your stop loss, you won't lose money. At the same time, you can let the remaining position run in profits without the stress, as your trade is now risk-free. Alternatively, another entry setup involves waiting for the price to return to the trading zone and watching for candlestick reversal patterns, such as a long wick rejection. This approach is particularly useful when the trading zone is large, allowing you to secure a better entry price. For this setup, place your stop loss above the trading zone and apply the same exit strategies mentioned earlier. By combining these methods, you can balance safety with profit potential and approach the market with greater confidence. Next, Let's look at gold on the 15-minute chart. The market is in a strong downtrend, and the most recent impulsive move has created a clear fair value gap, signaling strong bearish momentum. The order block within this retracement zone offers a potential entry point for sellers. However, if the price breaks above this area, it could indicate a shift in market direction and a potential reversal. Now, take note of how the market has formed an overlapping FVG zone and breaker block. This overlap creates a high confluence area, offering a strong opportunity for a reversal trade. Our plan is straightforward. Enter at the start of this high confluence zone and set the stop loss just below it to protect against unexpected moves. For targets, focus on key levels in the market structure ahead of the price, aiming for a favorable risk-to-reward ratio. This setup allows us to trade with confidence, leveraging the alignment of multiple price action signals to improve accuracy. By sticking to this approach, we maximize our chances of catching high-probability trades during this reversal opportunity while keeping risk tightly controlled. Now that we've mentioned this trade entry as part of a trend reversal strategy, it's crucial to emphasize the importance of combining multiple time frames and price action factors for better results. This includes using concepts like top-down analysis, identifying market trends, and incorporating higher time frame supply and demand zones into your analysis. For example, in our gold trade scenario, imagine the market has tapped into a higher time frame demand zone. If a pattern like the unicorn model forms within this context, it provides double confirmation. The higher time frame analysis aligns perfectly with the lower time frame entry setup. Even though the lower time frame shows bearish momentum, the higher time frame might still be in a bullish structure. In such a case, this long entry aligns with the dominant uptrend, significantly increasing the likelihood of hitting our targets. However, here's a critical point to remember. No matter how strong a trading opportunity seems, or how many confirmations align, never assume the outcome is guaranteed. Trading is all about predicting movements based on probabilities, but the future remains inherently unpredictable. The essence of technical analysis and price action lies in identifying repetitive patterns created by consistent participant behavior. Beyond that, we have no control over market movements. It's also important to manage expectations. A strategy with just a 40% win rate, paired with a solid risk-to-reward ratio of 1 to 2, and risking only 3% of your capital per trade, can still yield substantial profits over the long run. You don't need to win every trade to succeed. Unrealistic expectations, however, can trap beginners into chasing losses and losing their hard-earned money. The key is to stay disciplined, trust your strategy, and understand that consistency, not perfection, is what leads to long-term profitability. Now, combining multiple key trading zones isn't exclusive to the unicorn model. Another highly effective combination often seen in the market is the overlap of a fair value gap with an inversed fair value gap. But what does this mean exactly? You're already familiar with fair value gaps. These are voids between the wicks of 3 consecutive candles, indicating strong buying or selling pressure, often driven by institutional orders. When the price revisits these gaps, there's typically a higher likelihood of rejection as the market reacts to these areas. But what happens if the price fails to reject these zones and breaks through instead? This creates what's called an inversed fair value gap. An inversed fair value gap occurs when the market neglects the original FVG, breaking through it instead of respecting it. This shift transforms the FVG into a new type of zone, changing its role from a supply or demand zone into its inverse counterpart, depending on the direction of the breakout. For example, if a bullish FVG is broken to the downside, it becomes a supply zone, signaling potential selling pressure. Conversely, if a bearish FVG is broken to the upside, it shifts into a demand zone, indicating possible buying interest. Now here comes an important point. When a standard FVG and an inversed FVG overlap in the same area, this creates a high confluence trading zone. These areas are powerful because they combine the remaining institutional activity from the original FVG with the new characteristics introduced by the breakout. Traders can use this overlap as a prime opportunity for entries, provided they align with the broader market context and structure. So let's see a real chart example. Here on the Euro-Dollar 15-minute chart, we start with a clear uptrend. The market makes an aggressive push to the upside, forming a fair value gap and breaking above the previous market structure. This breakout is a strong signal that buyers are in control, and the price is likely to keep going higher. But then, things take a sudden turn. The price drops sharply, breaking below the previous low with strong momentum and creating another FVG zone. Now here's the interesting part. Look closely at how the initial FVG overlaps with another in the same area. This overlap creates a high-quality supply zone, a key area where sellers are likely to step in. When the price retraces back to this trading zone, there's a higher probability of rejection, pushing the price downward. This setup offers a prime opportunity to enter a short trade, aligning with the bearish momentum. Sometimes, overlapping two zones creates a large trading area on the chart. The issue with a large key zone is that if you enter at the start of the zone and place your stop loss below it, or even lower, like below a swing low, you'll end up with a wide stop. This can result in a poor risk-to-reward ratio, sometimes even less than 1-to-1 before the price reaches important levels. So how do you fix this? The answer lies in optimizing your entry to secure a better price and tighter stop loss. One simple approach is to aim for the middle of the zone. While this reduces your risk, the downside is that you might miss some trades if the price reverses before reaching that midpoint. Another technique is to use a Fibonacci retracement tool. Apply it to the impulsive movement, starting from its beginning to the end, and look for correction levels such as 61.8% or others that suit your trading style. Combining Fibonacci levels with overlapping zones can help you pinpoint more precise entry areas. Alternatively, you can wait for confirmation before entering. For example, a long wick rejection at the zone indicates that the market is reacting strongly to that level. You can then enter at the close of the rejection candle and place your stop loss below the zone, giving you a more calculated entry with reduced risk. While these techniques can improve your entries, the key is to backtest and refine them based on the asset you're trading. Price action works across all markets, but each trading pair has its behavior and characteristics. What works on one pair might not work as well on another. Consistent backtesting will help you understand which methods perform best for your strategy. That wraps it up for this video. I hope you found value in these insights. If you did, make sure to smash that like button and subscribe for more trading content. Thanks for watching, and I'll see you in the next episode.